What up, investors? Home Depot is reporting next week on the 16th. And naturally, I wanted to do a video. I wanted to do some analysis. So I dove into the numbers and found a couple of weak spots for the company from a balance sheet perspective and also industry perspective. So I'm going to share that with you now. First of all, a quick overview of the company. If you're not familiar with Home Depot, you probably don't live in the States. Everyone knows Home Depot. They do everything housing related. This is their website. They have huge, massive stores that have everything in there. A lot of contractors go in and purchase everything they need. The prices are very reasonable. Also, they have businesses in there. They have affiliated businesses. That gather business from the stores, like remodelers, all kinds of things. People who cut up window screens for you, all kinds of services. Anything you can think of that needs to be done for your house, they do it. So it's a massive company. It's absolutely enormous. We go to stockanalysis.com now to try to figure out what's going on here. The market cap is $291 billion. So it's a very, very large company. They revenue a little bit, about half of their market cap. And their net income is $17 billion. So very small comparative to their market cap, especially for a retailer, but it puts it at a PE of 17.24 apparently. Now, first, before we go into anything else, we're going to go into the financials. I have pulled up the quarterly report, but it's not going to give me any more insight than what I'm seeing here, especially what I'm trying to communicate. So first, we're going to take a look at all the important metrics that I think are pertain to our situation here. And first is the revenue. Now, the revenue is coming off of the 2020 period highs and probably going to end up back on trend. So I'm expecting some softening, maybe a strong quarter. The next one can be stronger, and the next one even stronger, but probably on trend with last year, maybe a little bit below, who knows. It looks like it's going to be topping off here, continuing the trend back from 2018. Net income looks like it's a fairly weak quarter compared to last year. It's about even, and it's not growing, but it's not shrinking either, so that's good. Let's see what it was last year. This time, it's almost exactly identical. A tiny bit of an increase from 2022. Furthermore, shares outstanding. And here we get into the meat of the discussion, right? They've been buying back shares over a long period of time now, since before 2013. I don't know how far back it goes, doesn't matter. It could be 20 years, doesn't matter. And this is an innovation that a lot of American corporates have come to do. What they do basically is they have ever-increasing dividends. I spoke about this on a different video I made yesterday or the day before that, when I was talking about Citibank or Regions Bank, one of the others. But what American corporates have started to do, it was an innovation, I don't know how long ago, but share buybacks have been around forever. However, the ever-increasing dividends pair really well with share buybacks. So many companies have done this in order to keep that status of ever-increasing dividends. So what happens is they'll increase the dividend, but by buying back shares, they decrease the amount of shares they have to pay that dividend to. You see how that works? So now, the fact that they're buying back shares gives them leeway to increase dividends. So it's a very clever innovation, and because the dividends are increasing, their shares become more valuable, and people gobble them up. And so it creates a lot of demand for shares from the company itself and from investors. And there's a good reason to, with the increased dividend that's hopefully, covered by the income of the company. So shares outstanding decreasing means they're buying back shares systematically over a long period of time, and you can see how dividend per share is increasing systematically, almost identical each year. They have some kind of a raise, about 15% or so, which is massive, by the way. But here we go. Like, if you just look at these metrics, you'd be like, man, this is such a good investment. Like, I buy it now, and then 10 years from now, this will have doubled. They'll have, instead of 2 cents per share dividend, they'll have $4 per share dividend per quarter. They will have bought up more shares, and I'll have a better, larger, own a larger share of the company with my 1 share. And everything is pretty, but not so fast, right? Not so fast. I'll show you why later. So profit margins, fairly stable. They like to keep them around 9%. That's fine. Totally fine. And then let's go to the balance sheet here. So this is where I started to get worried. So cash and cash equivalents, fine. They like to keep it around the $2-3 billion, $4 billion dollar mark. That's totally fine. They need to operate the company, and they need some cash on hand. That's perfectly good. Current assets 32.47. Total assets 76.45 billion. So it's kind of been stabilizing, right, since 2021. Their total assets, and then we want to go to total liabilities to balance that thing out, and it looks like it's a little bit under total assets. So that means shareholders' equity is about $2 billion. And you look at shareholders' equity. Now, many would argue, well, yeah, having shareholders' equity this low on a retail like this will increase efficiency, and that could be true. That could be true. But what you're always giving back something, all right? Look, from 16 to $2 billion shareholders' equity. You're always giving back something. So increase efficiency in order to do what? Decreasing resilience. Okay? The company is less resilient. Do you guys remember during the whole trade war thing with the East, with our friends to the East, how the whole globalization trend was coming to an end, right? And everyone's becoming more and more nationalistic. There's a nationalistic wave going across every country out there. The US, the UK, right? Basically every country, including China. So what that did was expose, and especially with the decrease in globalization and the whole situation in 2020, we figured out that this hyper efficiency of the global economy made it very fragile to disruption. So a tiny disruption all of a sudden caused lots of grief for the entire global economy. So efficiency comes always at a price of resilience. So that's one of my issues here with Home Depot, that they're starting a trend they may not be able to sustain for too long. Look at their debt level. Now, you might look at this and say, okay, well, that's fine because the company's been growing, the revenue has been growing at the same rate, the earnings have been growing at the same rate, they've been buying back shares, with this money and increasing the dividends, and they can totally cover it because the market cap of the company is going up and everything is fine and dandy. I love Home Depot. Well, not so fast. The cost of debt is not what it used to be. Okay, in the last 10 years or more, before 2022, the cost of carrying debt on your balance sheet was like zero. It's free. You couldn't get enough money. You couldn't get enough people to pay you enough to have debt on your balance sheet. For crying out loud, Europe, right? Japan had negative interest rates on a lot of their government debt. The rates were so low, people were literally paying you to take on debt. It's incredible. But this last year, we're now living in a different environment. So when this debt has to be rolled over, it's going to be a different story, right? The interest paid is going to be higher, and what happens, God forbid, the housing market starts going down. So far, it's been very robust. It's been frozen. I don't want to say robust. It's been thin, and frozen, but it's still elevated. Things have not come to a crash and may not come to a crash because of many factors that are not going to be discussed in this video. Plus, I'm not the biggest housing expert anyways. But I'm just saying it's a possibility that the housing market comes to a slowdown and a decrease. And since this business is so correlated with it, with these high rates, not only is this debt going to start to weigh on them, but it's going to interrupt their whole operation. And I feel like they've been digging themselves in a hole, in this tunnel that it's not always easy to get out of. Like, if things are the same now, things are the same 10 years from now as they are right now, then the company's going to be fine. All right? Nothing wrong. This will be, instead of 50 billion, it will be 100 billion. The dividend will be twice as much. The revenue, everything will go up on trend. They'll keep buying back shares and everything will be fine and dandy, right? They'll keep improving the efficiency of their business. But what happens if it doesn't, right? That's the whole entire point of being resilient, is you're able to withstand shocks to the system. Like, don't get me wrong. They survived well during, this is the price for the last 5 years. Where's March 2020? This should be it here. No, this one. Sorry. Okay, so March 2020 experienced a crash from 227 down to 141, just like everybody else. And then resumed steady growth. Whoa. All the way up to 402. And then now it's all the way down to below 300. It's been hovering around 300 mark for the last, year and a half maybe. But during this entire time, okay, this was a housing boom, okay? And this was a housing boom, and now the housing boom has stopped. The price has adjusted accordingly, but it has not started a decline. So when a decline happens, like, you can't really see it over here in the revenue figures. Look, revenue in 2020 looks exactly the same, if maybe even higher, right? Look at 2020, huge boost, right, in third quarter. First was a little bit slow, second was normal, huge boost. So they actually benefited, right? Home Depot benefited from the entire experience of 2020. But just what happens if something doesn't work out in their favor, like a housing slowdown? There was no housing slowdown in 2020. Nobody said, oh, it's there's a pandemic on the streets, let me go sell my house. No, nobody sold their house. No way. And so it just hasn't happened. But in case it does, right, this company is at risk. It just looks robust right now because of how it's been performing over the last few years. And there you go, dividends, right? Dividend growth of 13.72, payout ratio of 45, so a little bit under half of the earnings that they make is paid out in dividend. Dividend yield is just under 3%, which is perfectly fine for this price. And an ever-increasing dividend. Look at this. There's the dividends chart. Ever-increasing dividend every year. Pop, 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 pop. This is their yield growth per year. It looks like 15% last year, 10% the year before that, 32% dividend increase in 2019. Okay, 30% in 2017. So sometimes it's kind of like getting a raise, right? So if you own this company, you get a raise. Sometimes one year you'll get a raise of 20%, 25%, then 17%, 29%, 15% the next, 32% 2019, right? So this all compounds. So if you've been owning and reinvesting, or just owning really, Home Depot for the past 10 years, you're happy right now. But given these metrics, right, given these valuation metrics here, if we go to the statistics, I'm not so sure that there aren't better deals out there in the market when it comes to retailers. All right, it's a little bit on the pricey side. Like, look at the price to free cash flow ratio, which I like to look at, is 25. It's not the best ratio out there when it comes to like really innovative companies. Like, tell me one reason why you would own this over a company, let's say like Apple. EV to free cash flow 29, right? So net cash negative 47 billion. So I don't know. I mean, personally, just because of the fragility of the company, I don't want to own it. I don't want to do anything with it. But given nothing crazy happens to the housing market 10 years from now, in the interim, the company is just going to be fine. It's going to be a great investment. So that's my conclusion. But personally, just I don't see something where I can feel like, all right, I can leave this for 10 years, come back, and the company's still going to be just as profitable. It's just not the case. I'm giving it like a 50-50 chance that that's not going to work out. So that's my theory here. And in fact, I think because of the rate increases that we have experienced, we've yet to see some lag effects from that. And I'm guessing that in the next year or two, it's going to start showing up. The cracks are going to start showing up in the housing market, and Home Depot is going to be affected. So far they have a really good moat, but they're also not immune from competition. I mean, so far no one's really stood up to them out there, so they don't really have serious competition. But technology improves, it changes, new innovators and disruptors come into all kinds of spaces and disrupt things. And maybe just too big and too slow to pivot. So, I don't know. But that's also a risk for the company. So we got like 3 things, okay, from like weakness in the balance sheet when it comes to resilience, industry when it comes to like negative surprise for the company. And then we also have the whole entire like innovation risk from outside competition going into the space. Plus, many companies, it doesn't have to be from a startup, guys. Don't think of it like that. I know what you're thinking, right? You're thinking, okay, so Home Depot is such a big company and so well established and all that. Like, a startup is not going to come into the home rebuilding business and like start winning over Home Depot, buying up warehouses and all that and trying to replicate its capital intensive model. Don't think of it like it has to be from a startup. Like, you don't have to have a startup going, look, Apple just went, into savings, into finance, just like this, right? They partnered with Goldman Sachs. They got a credit card out there. Now they're building like some savings account or what have you. They're going into finance, right? So now they're competing all of a sudden from outside the industry. A behemoth, right, is coming into the industry and competing with all these fintech like online banks and all that stuff and traditional banks and CDs and all this crap. So they're competing with that just like that out of the blue, just because they decide to. And they have billions and billions of cash sitting in their bank accounts, like wondering what to do with them. So it can be just another company from outside of the industry coming in and competing on a level that we haven't even imagined yet. So don't think like Home Depot is immune from competition. Okay, so there we go. I listed all some risks, some of the reasons why I'm not too interested in the company. However, I will admit the company's performed really, really well over the past in the low yield environment. I don't know if that's going to be the case in the next 10 years, but if things go as they have been in the last 10 years, then Home Depot will be a great investment. That's all I got to say. Mic drop.